China presently manages a colossal reserve of $3.2 trillion in U.S. assets, comprising treasury bonds, corporate debt, currency reserves, and mortgage-backed securities, far surpassing any other nation's holdings. It holds more than Japan, the United Kingdom, or all of Europe combined. For years, experts and policymakers have warned of the looming threat. What if China suddenly sold off all these assets? Such an act could send the dollar into free fall, spike interest rates, and push the U.S. into a financial crisis, ending its economic dominance overnight. This threat has been dubbed the nuclear option, a potential weapon of mass destruction, a strategic ace that haunts American policymakers' minds. Yet, what remains little known is that China cannot, and will not, wield this weapon, because pulling the trigger would mean their own destruction, a complete economic annihilation. The $3.2 trillion isn't a weapon at all. It's a trap from which both superpowers are inseparably bound. This scenario constitutes the most intricate financial hostage situation ever devised. Two superpowers, each holding a gun to the other's head, fully aware that any trigger pull would trigger mutual destruction. What makes this situation so unsettling isn't merely the threat of what could happen, but the gradual unraveling already in progress. China, recognizing its entrapment, has been quietly attempting to escape for the past 15 years, buying gold, developing alternative payment systems, and diversifying away from dollar reliance. Still, the depth of the trap and the scale of exposure are so vast that true escape is measured in decades. The real question isn't whether China will eventually break free, it's whether the trap will collapse first. Let's explore how this trap operates, why it's inescapable, and what current efforts both nations are making to avoid catastrophic fallout. Beginning with China's dollar holdings. As of July 2025, official reports indicate China possesses roughly $731 billion in U.S. Treasury securities, its lowest level since January 2009, signaling a systematic reduction over the years. In that month alone, China decreased its holdings by over $25 billion, marking the largest single-month cut in nearly 2 years and shifting its ranking from second to third among foreign holders. Japan remains the top with about $1.15 trillion, followed by the United Kingdom with nearly $900 billion, with China trailing behind. Yet, this is only part of the full picture. China also holds substantial positions in U.S. corporate bonds, estimated between $300 billion and $500 billion, covering technology firms, financial institutions, and industrial giants. Additionally, China holds U.S. dollars and foreign exchange reserves, cash sitting uninvested, amounting to roughly $500 billion to $700 billion. China's holdings in U.S. assets, comprising between $2.8 trillion and $3.5 trillion, extend beyond treasuries to include significant investments in U.S. corporate bonds, currency reserves, mortgage-backed securities, and equity stakes in American companies. Notably, China holds an estimated $200 billion worth of mortgage-backed securities, including those issued by Fannie Mae and Freddie Mac, the very securities that nearly precipitated a global financial meltdown in 2008. Since the crisis, China has amassed hundreds of billions more in these assets, and today, the total value is roughly $200 billion. Additionally, Chinese sovereign wealth funds and state-controlled enterprises possess between $1 trillion and $1.5 trillion in U.S. equities. When these figures, treasuries, corporate bonds, foreign exchange reserves, mortgage securities, and equities, are combined, China's overarching dollar exposure is at least $2.8 trillion, possibly stretching to $3.5 trillion. Most analysts cite the figure of $3.2 trillion as a midpoint estimate, not because it's precise, but because it broadly encapsulates China's accumulated dollar holdings and the so-called dollar trap. Why does this number matter so profoundly? Because it's not just sizable, it's structurally embedded within China's entire economic framework. Over the past 4 decades, China built this vast dollar reserve through a single primary channel: persistent trade surpluses. From the 80s through the 2000s, China operated the world's largest ongoing trade surplus, exporting manufactured goods like electronics, textiles, machinery, toys, and furniture globally. The international market paid for these goods in U.S. dollars, which Chinese exporters then exchange for yuan at domestic banks, forwarding those dollars to the People's Bank of China. The central bank, inundated with incoming dollar inflows, couldn't simply hoard cash, as it yields no return and erodes in value under inflation. Instead, it invested heavily in U.S. Treasury bonds, considered the safest, most liquid assets in the world, backed by U.S. government guarantees. This purchasing served a dual purpose. Besides earning returns, buying treasuries helped China sustain a deliberately undervalued yuan. Every purchase of treasuries meant selling yuan and buying dollars, keeping the yuan's value suppressed relative to the dollar. This undervaluation made Chinese exports cheaper for American consumers, boosting sales and increasing dollar inflows into China's economy. This created a self-reinforcing cycle. Heightened exports led to more dollars, which financed further treasury purchases, enabling China's export-driven growth model, embodying the core essence of its dollar trap. These dollar assets, bonds, securities, reserves, and equities, are not merely external holdings. They are intrinsically woven into China's entire developmental strategy. They symbolize a nation's savings after 40 years of rapid, export-led expansion. This leads us to a common, yet deeply alarming fantasy. What if China suddenly offloaded all $3.2 trillion of assets? Theoretically, such a haul would involve China instructing its bond traders to liquidate every treasury holding at once. An immediate sale of all $731 billion in treasuries would cripple the global bond market, which is renowned for its liquidity. The repercussions? Markets would freeze up, prices of bonds would plummet, yields would skyrocket, potentially hitting 10% or even higher among the 10-year treasury. This abrupt spike would distort borrowing costs across the economy. Mortgage rates would skyrocket to well above 14%, the housing market would grind to a halt, and consumer borrowing would become prohibitively expensive. Corporate debt refinancing would grind to a halt, defaults would surge, and financial institutions holding treasuries would see their assets deflate and their balance sheets threaten collapse. In an attempt to stabilize the chaos, the Federal Reserve would be compelled to intervene by purchasing these vast sums of treasuries, effectively printing hundreds of billions of dollars, unleashing inflation and debasing the dollar's value. The consequences? A cascade of inflationary chaos, soaring energy costs, a collapse in the American economy, and a burgeoning dread of a full-blown financial meltdown. However, the harsh reality is that such a move by China would self-destruct more swiftly than it would harm the U.S. The moment China attempts to offload its dollar assets en masse, it suffers immediate and catastrophic losses elsewhere, particularly its sizable dollar-denominated holdings. Forthcoming, we see the dollar itself would plunge against other currencies, dropping by perhaps 30% within weeks, wiping out nearly $750 billion in Chinese reserves alone. This loss directly threatens China's entire foreign exchange reserve base, which is roughly $3.3 trillion, representing a staggering 22% depletion, a solvency crisis in its own right. Moreover, China's export economy, accounting for about 20% of its GDP, would collapse as demand from the U.S. dried up, and the yuan would surge in value relative to the dollar, making Chinese goods far more expensive and uncompetitive internationally, reducing exports even further. Domestically, the financial system would buckle under the weight of dollar debt, as Chinese companies and banks had borrowed in dollars to fund their operations. A surging yuan would inflate the real cost of these dollar debts by over 40%, leading to defaults on trillions of dollars of corporate borrowing, sparking a banking crisis, social unrest, and a severe economic downturn. Simultaneously, China's energy imports, priced globally in dollars, would become prohibitively expensive as the dollar's value falls, injecting inflationary pressures into the economy. This sequence of events would rapidly unravel China's export-driven economy, financial stability, and social cohesion, much faster and more devastating than the damage that would be inflicted on the U.S. by such an impulsive dump. Unlike the United States, which benefits from the depth and diversity of its financial markets and the capacity of the Federal Reserve to print dollars as needed, China's economy is fragile, heavily reliant on exports and energy imports, with limited scope to cushion such shocks. Unlike the dollar, which has become the dominant global reserve, The yuan lacks international trust or market infrastructure to absorb such a crisis. This is why the so-called dollar trap isn't a weapon China can wield. It's a burden, a self-imposed straitjacket. When Beijing considers untangling itself from its dollar holdings, it faces a paradox. Any sudden move risks ruin, but gradual withdrawal would take decades, possibly 30 years, to fully shift away from dollar dependence. During this period, both China and the U.S. remain locked in a precarious standoff, each unable to act without catastrophic consequences for the other. Efforts to escape are ongoing. China has been quietly diversifying by acquiring gold, establishing international payment systems, and building bilateral currency swap arrangements to facilitate trade without dollars. Initiatives such as the Cross-Border Interbank Payment System, launched in 2015, are designed to replace the SWIFT network and process transactions directly in yuan, bypassing dollar reliance. China has also signed swap agreements with dozens of nations, creating a constellation of bilateral currency arrangements aimed at fostering a yuan-based trade network. The goal is to develop a yuan-centered ecosystem, where oil and commodities are traded directly in yuan, lessening dependence on the dollar. Nevertheless, these shifts are slow, taking decades, and the world's entrenched reliance on dollar dominance makes rapid change unlikely. For now, most countries continue to prefer the convenience, depth, and legal enforceability of dollar-based trade. Simultaneously, China is attempting to shift its economy internally, encouraging domestic consumption to reduce its dependence on export-driven dollar inflows. Since 2013, policy measures have aimed to elevate consumption from roughly 38% of GDP to 60% over 20 years. While progress has been slow, rising to 55% by 2025, it's insufficient to offset the fundamental problem. Rising wages make Chinese exports less competitive, prompting manufacturing to move to other countries, further diminishing future dollar inflows. Despite a shrinking trade surplus, down from $400 billion annually in 2015 to about $250 billion in 2025, China's existing dollar assets remain a liability. They cannot be sold off en masse without dragging down the dollar. The ongoing internal rebalancing can slow the accumulation of new dollars, but cannot eliminate China's existing dollar holdings. Looking ahead, the timeline is critical. Since 2008, after the financial crisis, China has been gradually attempting to diversify away from dollar dependence, increasing gold reserves, forging new trade and currency arrangements, and boosting domestic consumption. As of 2025, despite significant progress, China is roughly a quarter of the way along this path, with full diversification likely taking 2 to 3 more decades. That means the full escape from the dollar trap might not occur until the mid-2040s to mid-2050s. However, the core issue is whether the dollar's structural flaws, persistent deficits, mounting debt, trigger a crisis earlier. The U.S.'s national debt exceeds $380 trillion, with annual interest costs nearing $1 trillion, indicating unsustainable fiscal growth. If the dollar were to collapse prematurely, China's dollar holdings would be wiped out almost instantaneously, delivering catastrophic losses. Thus, both nations are locked in a perilous standoff, each aware of the other's vulnerabilities, each unable to act decisively without risking mutual destruction. The U.S. cannot fully weaponize its financial system against China, for fear that freezing or seizing Chinese dollar reserves would lead to economic chaos on both sides. Simultaneously, China cannot rapidly liquidate its dollar assets without ruining itself in the process. This crisis, the greatest in modern financial history, remains largely invisible to the public because both sides deliberately avoid acknowledging its existence. The slow erosion of dollar dominance is quietly advancing. As China gradually diversifies, U.S. debt spirals, and confidence wanes, the global reserve system's foundation is weakening. Should the dollar's share of reserves dip below half, expected around 2030 to 2032, it will no longer be a question of whether the dollar remains dominant, but what will replace it. China's long-term strategy involves accumulating gold, forging alternative trade systems, and shifting domestic policy toward consumption, aiming to eventually obviate reliance on dollar reserves. But these plans require patience. decades of gradual transformation. While the economic and political systems of the U.S. and China teeter on the edge of unprecedented upheaval. The irony is stark. The foundation of global finance, built on mutual dependence, has morphed into a trap that threatens both. For over 40 years, the U.S. benefited from cheap Chinese labor and a steady stream of dollar inflows, fostering economic growth and stability for both nations. Now, the same interconnected system is destabilizing, and neither country has an easy way out. Both are fighting to escape a cycle that can either unravel slowly or culminate in catastrophic collapse, neither side truly willing or able to fully break free. Understanding this geopolitical and financial stalemate is vital. It shapes the trajectory of the dollar and the global economy. As the trap slowly unwinds, your savings, investments, and purchasing power are all caught in the evolving currents. Recognizing the nature of this predicament allows you to position yourself, through assets like gold, Bitcoin, or other hard commodities, outside the collapsing framework that has underpinned global finance for decades. This is the most critical and overlooked financial dynamic of the era, a silent yet powerful force shaping the future. Both sides are aware but choose silence, hoping to navigate the perilous cliff's edge before it falls. But the countdown has begun, and the next few years could determine whether we witness a gradual rebalancing or a sudden, catastrophic crisis. The real story isn't about choosing sides. It's about understanding the underlying architecture of global finance, the true, unfolding trap, and preparing accordingly. Absorbing $331 billion in sell orders would cause the bond market to seize up as prices plummet. When bond prices drop, yields soar, with the 10-year Treasury yield, currently near 4.5%, potentially surging to 8 or even 10% amid panic. This immediate spike triggers a chain reaction across the economy. Mortgage rates, which are pegged to this yield, would jump to 13 or 14%, freezing the housing market. Home values would plummet as affordability evaporates. Consumer spending, comprising around 70% of the U.S. economy, would collapse since home equity is a key wealth store for Americans. Corporate borrowing would become nearly impossible. Refinancing debt at interest rates of 12 to 15% would be unfeasible for many firms, leading to a surge in defaults. The banks holding these treasuries would see asset values evaporate, causing balance sheet collapses and risking a broader banking crisis. To stabilize the markets, the Federal Reserve would have to buy the dumped treasuries, printing hundreds of billions of dollars, an expansion of the money supply on a wartime scale, fueling inflation once again. As the dollar weakens globally, import prices would skyrocket. America's bought goods, electronics, cars, clothing, food, would double in cost, pushing inflation to 20 or 30% annually. The economy would slide into stagflation, stagnant growth paired with high inflation and unemployment. Meanwhile, government borrowing costs would surge. Currently, the U.S. pays roughly $1 trillion annually in interest on its national debt. If interest rates double, that figure would balloon to $2 trillion, surpassing combined defense spending, Medicare, and a significant portion of Social Security. The nation's fiscal capacity would be strained beyond limit, forcing drastic cuts or unprecedented money printing, accelerating the crisis. This scenario, the nuclear option, depicts a financial catastrophe where China's attempt to unload treasuries triggers the implosion of the U.S. economy. Yet, the harsh reality is that such a move would destroy China even more swiftly. The immediate aftermath would be a sharp dollar collapse, perhaps losing 30% of its value against other currencies in mere weeks. While catastrophic for the U.S., China would suffer even greater losses because it still holds the remaining $2.5 trillion worth of assets, corporate bonds, mortgage-backed securities, currency reserves, and equities. The currency devaluation would wipe out around $750 billion in China's holdings, more than 20% of its entire foreign reserve base, destabilizing its entire financial system. This internal collapse would hit China's export-dependent economy first. With a surge in the yuan's value relative to the dollar, Chinese goods would become over 40% more expensive for American consumers overnight. Coupled with the loss of dollar liquidity, Chinese companies relying on dollar debt would face refinancing crises, leading to defaults and a banking meltdown. Furthermore, China's energy costs would double since energy commodities, priced globally in dollars, would become more expensive, hammering its manufacturing base. The entire Chinese economy, built upon cheap energy and low-cost exports, would grind to a halt. Thus, the act of dumping dollar assets, intended as a lethal economic weapon, would backfire catastrophically. Both nations are deeply intertwined. China's dollar holdings are the core of its financial stability, and their sudden loss would cause an internal implosion far faster than the U.S. would experience it. This is the paradox of the dollar trap, a self-destructive weapon China cannot wield without destroying itself. In a matter of weeks, China's central bank balance sheet, intended to support the dollar, suffered a devastating blow of approximately $750 billion. To put this into perspective, as of September 2025, China's total foreign exchange reserves hovered around $3.34 trillion. Losing nearly a quarter of that, 22%, represents a solvency crisis, not a minor hiccup. But the fallout extends far beyond reserves. China's economy hinges heavily on exports, which make up about 1/5 of its gross domestic product. The United States alone receives around $500 billion worth of Chinese goods annually. Should the dollar falter and trigger a U.S. economic downturn, American consumers would no longer demand Chinese products, causing demand to vanish. Consequently, Chinese manufacturing reliant on U.S. orders would grind to a halt, and unemployment in China's export sector would soar. The most alarming point, however, is that even if American consumers still wanted Chinese goods, they'd be unable to afford them. When the dollar collapses, say it loses 30% of its value, the yuan would surge by roughly 43% relative to the dollar, making Chinese products significantly more expensive overnight. This surge in the yuan's value would price Chinese exports out of the American market. Adding to China's woes is its financial dependence on dollar liquidity. Chinese banks have borrowed dollars internationally to fund local lending, and Chinese companies have issued dollar-denominated bonds attracted by comparatively lower U.S. interest rates. When the dollar plunges and U.S. interest rates climb to 10%, these Chinese borrowers face a dire refinancing crisis. They owe dollars but generate revenue in yuan, which now surges by approximately 43%. Most of China's corporate debt, around $3 trillion, would then become roughly $1.3 trillion more expensive to service in real terms. Many firms would default, triggering cascades of losses across Chinese banks, which hold these bonds or have lent money to affected companies. China's government, lacking sufficient resources after losing about $750 billion of reserve value, would be compelled to print yuan to cover the mounting losses. This monetary expansion would reignite inflation, something China's authorities have successfully constrained through strict policies, leading to runaway price increases. Ordinary Chinese citizens, whose wealth is predominantly tied up in land and real estate, would see their purchasing power evaporate, sparking social unrest. The crisis would deepen with energy imports, predominantly priced in dollars, such as oil, natural gas, and coal. As the dollar collapses, China would have to pay more yuan for the same energy supplies, effectively doubling energy costs. This surge would feed directly into inflation and render Chinese manufacturing uncompetitive, causing the entire economy to decelerate. In sum, China's attempt to shed its $3.2 trillion in dollar assets would result in a catastrophic loss of nearly $750 billion on remaining holdings. Simultaneously, its trade and financial systems would face insurmountable stress, pushing the economy into chaos. Their export sector faces rapid collapse as American demand vanishes, and the surging yuan renders Chinese goods uncompetitive globally. Simultaneously, China's corporate landscape confronts a debt crisis fueled by currency mismatches, leading to bank failures and a government compelled to print money. Inflation skyrockets, energy prices double, and social unrest begins to stir. All these upheavals unfold faster than in the United States, because China's economy is inherently more fragile. The U.S. benefits from the world's deepest capital markets, a diversified economic base, and the Federal Reserve's capacity to print dollars and stabilize the system. China lacks these advantages. The yuan is not a global reserve currency, so no one prefers holding it during a crisis. Its capital markets are smaller, controlled by the state, and its economy relies heavily on exports and external energy supplies. When the dollar trap ultimately breaks, China's economy crumbles more swiftly than America's. That $32 trillion holdings are not a weapon. They're a hostage, pinning China in a self-inflicted crisis. The nuclear option, dumping treasuries, is a gun pointed at their own head, a mutually destructive move both sides understand. Therefore, China isn't seeking to unload its dollar reserves overnight, but is slowly, carefully, attempting an escape over decades. Their strategy comprises three key pillars. First, accumulating gold. Second, developing alternative payment systems. And third, fostering a new yuan-based trade network. Since 2015, China has launched the Cross-Border Interbank Payment System, or CIPS, an alternative to the dollar-dominated SWIFT network, which now processes roughly $14 trillion annually, still modest compared to SWIFT's $150 trillion, but growing at a rate of about 30% each year. Additionally, China has established bilateral currency swap agreements with nations including Russia, Brazil, Argentina, Saudi Arabia, the UAE, and Pakistan, totaling over $500 billion. The ultimate goal is to create a yuan trade bloc where Chinese imports and exports are priced and settled in yuan, bypassing the dollar entirely. Imagine China buying oil from Saudi Arabia in yuan, which Saudi Arabia then uses to purchase Chinese goods. Such a system would eliminate dollar demand altogether and negate the need to hold dollar reserves. This long-term plan aims to shift enough trade into the yuan so that China's export-driven economy becomes independent of dollar accumulation. But this transformation will take decades. No country readily abandons the dollar unless it's clearly advantageous. Today, for most nations, the dollar remains more convenient, more accepted, with deeper markets and enforceability under U.S. law. As a result, the shift proceeds gradually, only a few percentage points each year. Since 2015, China's portion of global trade settled in yuan has grown from a modest 2% to approximately 7% by 2025. Although this progress is notable, at the current rate, it would take roughly 30 years for the yuan to account for half of China's international transactions, a timeline that's immediately irrelevant, as the active dollar trap leaves China with no such luxury. China is also reshaping its economy internally, aiming to reduce reliance on exports by boosting domestic consumption, a strategic shift underway since 2013. The plan envisions raising consumption's share of gross domestic product from about 38% to 60% over 2 decades. To support this, the country has invested in infrastructure, expanded social services, increased wages, and transitioned toward a service-oriented economy. Progress has been slow but tangible. By 2025, domestic consumption had risen from 38% to 55% of GDP. However, this rebalancing presents a challenge. As wages climb, Chinese manufactured goods become less competitive internationally. Historically, China's dominance in manufacturing was based on inexpensive labor, but rising wages have prompted factories to relocate to countries like Vietnam, Bangladesh, and Mexico. Consequently, China's trade surplus, that peaked at $400 billion annually in 2015, has diminished to $250 billion by 2025. While that sounds promising as a step away from dollar dependence, the reality remains that China still holds roughly $3.2 trillion in existing dollar assets. This trap doesn't diminish simply because new dollars are no longer flowing in. It's a structural entrapment. Although China aims to actively shrink its dollar holdings, selling those assets en masse would crash the dollar's value, so they're effectively immobilized. The effort to pivot through increased domestic consumption reduces future dollar inflows, but does little to unwind the existing dollar-based obligations. Since initiating these diversification efforts in the wake of the 2008 financial crisis, China has made measurable progress. Their gold reserves have ballooned from 600 tons to over 2,300 tons officially, with estimates suggesting actual holdings approach 5,000 to 6,000 tons. Their share of trade settled in yuan has risen from 0 to 7%, and dollar-held treasury reserves have declined from $1.3 trillion in 2013 to approximately $731 billion in mid-202.5. Yet, they're only about a quarter of the way toward complete independence, and at the current pace, full diversification could take another 2 decades, or even 3, meaning China's dollar exposure would not drop below $1 trillion, the level at which they could feasibly unload large portions, until between the decades of the 45th and the 52nd. But the question remains, will the system endure that long? The United States itself is quickly accelerating its debt accumulation, adding roughly $2 trillion annually. As of late 2025, the national debt exceeds $38 trillion, with interest payments approaching $1 trillion annually, over 14% of all federal expenditure. The Federal Reserve has printed trillions to fund deficits, and inflation continues stubbornly. The global reserve currency status of the dollar is eroding, not because China is actively attacking it, but because the United States is devaluing it from within through persistent monetary debasement. The race is on. If the dollar collapses naturally before China manages to extricate itself, China would suffer catastrophic losses. The question is whether China can diversify away from dollar holdings before the dollar's own structural weaknesses trigger collapse. Currently, the answer appears to be no. The timeline doesn't favor them. China would need around 2 decades to fully shift, yet the dollar's inherent vulnerabilities suggest a crisis could erupt within 5 to 10 years. This means China is effectively trapped. To dump its dollar reserves would hasten its own destruction, while holding onto them risks ruin if the dollar collapses. It's a no-win situation, and the geopolitical tension only deepens because the U.S. isn't free from it either. U.S. policymakers are acutely aware that China possesses around $3.2 trillion in dollar-denominated assets, which it could, in theory, unleash during a crisis. This knowledge constrains U.S. actions. They can't be too aggressive, freezing Chinese assets or cutting off access to financial systems, because such moves could provoke an immediate, devastating sell-off by China. For example, when Russia invaded Ukraine, the U.S. froze roughly $280 billion in Russian reserves, simply seizing them. Russia was still able to access its own funds, making it an extreme but contained form of economic warfare. But with China, the stakes are different. Holding $3.2 trillion, if the U.S. were to freeze those assets, China would have little to lose. Their response would likely be a rapid, full-scale dump of assets, potentially destroying both economies in a mutual act of destruction. This scenario, mutually assured destruction, forces the U.S. to tread very carefully. They cannot push China too hard. No asset freezes, no exclusion from SWIFT, and limited use of other financial weapons. China's dollar reserves serve more as an invisible restraint, a strategic constraint on U.S. options, rather than an offensive weapon. Understandably, this is why China hasn't accelerated diversification efforts. Any sudden sale of even $500 billion could ignite panic, collapse markets, and lead to retaliatory sanctions. The repercussions would far exceed any gains from escaping the dollar trap, risking a complete breakdown of U.S.-China relations and access to critical technology and financial networks. In essence, both sides are in a perilous standoff. China cannot afford to unload its dollar holdings without triggering a self-destructive collapse, and the U.S. cannot fully weaponize the dollar without provoking a catastrophic crisis that destroys its own economy. It's the most intricate financial deadlock in history, yet surprisingly little understood because both sides pretend the underlying tension doesn't exist. What does this mean for the dollar? Paradoxically, China's slow, measured efforts to divest, reducing purchasing of treasuries by just a few billion or tens of billions annually, tend to bolster the dollar in the short term. Their gradual cuts, such as the approximately $25 billion in July of the current year, signal a controlled, measured decline, not a market panic. This measured approach allows the Federal Reserve to adjust interest rates gradually, markets to adapt smoothly, and prevents sudden shocks, thus sustaining the dollar's international reserve status temporarily. However, this slow erosion is not sustainable forever. Once the proportion of dollar reserves held by the rest of the world drops below around 50%, confidence in the dollar begins to unravel rapidly. Current estimates show the dollar's share of global reserves hovered around 56%, down slightly from higher levels at the turn of the century, yet the decline is accelerating. If the trend continues, the dollar could lose its reserve currency status as soon as the late 20s or early 30s, prompting a seismic shift towards regional currencies, gold-backed systems, or other alternatives. In this complex dynamic, neither China nor the U.S. can win outright. Both are tethered, one by the necessity to hold dollar reserves, the other by the peril of unleashing a destructive sell-off. The entire system, which has fostered unprecedented global interdependence, now faces gradual but inevitable disintegration. And whether the collapse leads to a managed transition or catastrophic chaos depends on factors still unfolding. Understanding this hidden standoff is crucial. It's not a simple U.S. versus China conflict. It's a mutual trap built on decades of economic dependence, beneficial for both, but inherently unstable. Both sides are acutely aware of the peril, yet neither can act openly or decisively without risking ruin. As this tense equilibrium teeters, the most vital asset you can hold, be it gold, Bitcoin, or tangible resources, is outside the confines of this fragile dollar system. Recognizing these forces arms you with the foresight to navigate the uncertain economic landscape ahead, because the unfolding crisis is the most significant financial event of the coming decades. This isn't a sudden crisis, but a gradual decline, a slow erosion that reaches a tipping point. Typically, when dollar reserves shrink below half of global central bank holdings, confidence crumbles. Other nations observe China reducing its dollar holdings and follow suit, causing the shift to accelerate swiftly. What begins as a slow transition then becomes rapid, not through deliberate Chinese aggression, but through market dynamics. Currently, in 2025, the dollar's share of international reserves hovers around 56 to 57%, down from 58% in 2024 and a stark 72% at the turn of the century. Over a quarter of a century, that decline of roughly 14 to 16 percentage points paves the way toward a critical threshold, around 2030 to 2032, when it might dip below 50%. But recent years reveal the pace speeding up. If that trend persists, the dollar could slip past this threshold as soon as 2028. The crucial point then shifts. Once the dollar ceases to dominate reserve holdings, the question becomes what currency or system will replace it. Regional currencies, gold-backed frameworks, and new trade alliances could step into the vacuum. The transition into this new arrangement would accelerate into a full-blown crisis, yet China need not initiate any aggressive action. Simply continuing their slow diversification and internal reforms will be enough for the dollar's structural weaknesses to do the rest. The irony of the situation is profound. Both the United States and China are ensnared in this trap, a creation born of mutual benefit. For 4 decades, from the early 1980s to 2020, this symbiotic relationship fueled unprecedented growth. China rapidly industrialized by exporting massive quantities of goods to the U.S., lifting hundreds of millions out of poverty and becoming the world's second-largest economy. The United States, in turn, benefited from cheap manufactured imports, affordable electronics, clothing, appliances, bolstering consumer purchasing power despite stagnant wages. American corporations thrived by offshoring production, Apple, Nike, General Motors, among others, and the stock market soared. Meanwhile, the U.S. government capitalized on this arrangement by issuing debt at historically low interest rates. China funneled its trade surplus dollars into U.S. treasuries, effectively subsidizing U.S. deficits and keeping interest costs manageable. This interdependence created a deeply intertwined system. China's economic rise depended on accumulating dollar assets, while American consumption depended on China's manufacturing outputs. Neither side could unwind this setup without risking catastrophic collapse. The entire system was akin to 2 mountain climbers roped together on a precipice. If one falls, both are doomed. Now, as China's labor costs increase and exports become less competitive, and as U.S. debt spirals beyond sustainable levels, the foundational benefits are fading. Yet, the trap persists. Both nations' efforts to escape, China through slow diversification into gold, alternative payment systems, and regional currencies, the U.S. through debt accumulation and dollar devaluation, are unfolding over years or decades. The process is akin to trying to find new safe footholds on a crumbling cliff face. The pathway forward remains uncertain, but the core reality is clear. Their mutual dependency has locked both into a perilous standstill. The gradual weakening of the dollar's dominance signals a future where the economic landscape will be fundamentally reshaped. Whether through a managed transition or a sudden upheaval, the eventual breakdown of this system appears inevitable, risking widespread upheaval in global wealth and stability. The outcome isn't if both sides admit they're trapped. They already do. Every central banker, finance minister, and economist recognizes the reality. They're locked in a precarious situation. The real question is whether they can find a way out before the entire system crashes. Over the coming 5 to 10 years, you'll observe China steadily diversifying, buying more gold, forging new trade agreements outside the dollar, and focusing on boosting domestic consumption. Meanwhile, the United States will persist in strengthening the dollar, engaging in increased deficit spending, more money printing by the Federal Reserve, and rising inflation. The dollar's status as the world's reserve currency will gradually diminish, today at around 57%, projected to fall to 50% by 2028, and perhaps 40% by 2032. At some point during this process, 3 scenarios could unfold. The first is a smooth, orderly transition, where the dollar remains powerful but shares the global reserve market with other currencies, creating a multipolar system. Asia, Europe, and the Americas would each rely mainly on their own currencies, easing the shift without crisis. This optimistic outlook hinges on wise leadership from both China and the U.S., stability in global politics, and no unforeseen shocks. Its likelihood, however, is relatively low, perhaps 20%. The second scenario involves a sudden crisis, a debt ceiling breach, a major bank failure, or geopolitical conflict triggers rapid loss of confidence. China is forced into hurriedly dumping its dollar holdings to protect itself, prompting the U.S. to retaliate. The result is mutual destruction, an immediate financial upheaval, depression, and currency chaos. Although stability might eventually return, it would come after devastating wealth destruction. This scenario probably carries a 50% chance. The third, and most catastrophic, sees the system collapse entirely before China can escape. Here, deep-seated issues like debt, deficits, and inflation cause the dollar to implode first. China endures severe losses on its $3.2 trillion worth of assets, with its economy imploding. The U.S. economy would follow, also shattered under the weight of a dollar collapse. Because China remains trapped at the moment of collapse, its losses would be even greater. Both nations would fall into prolonged crises. No winners, only losers, carrying about a 30% chance. None of these outcomes are desirable. The best case is a managed, gradual decline. The worst is mutual annihilation. And most likely, the reality will lie somewhere in between, chaotic enough to cause widespread disruption, but not outright destruction. What's crucial to grasp is that this isn't a rivalry of sides. It's a recognition of a flawed, unstable structure in which the two largest economies are intertwined in a trap that benefits no one yet binds them both. The $3.2 trillion holdings of dollars aren't a weapon China can wield against the U.S. They're a liability both nations are forced to bear. As the dollar weakens and U.S. debt surpasses $40 trillion, and as China tries to escape, these instabilities only deepen. We're witnessing the slow collapse of the financial framework that defined the past 4 decades. When it ultimately fails, it won't matter whether you support the U.S. or China. Your savings, investments, and purchasing power are all denominated in currencies caught in this dangerous trap. The dollar's value will wane, and the yuan will experience erratic fluctuations. Regardless of how the transition unfolds, it will wipe out wealth on a scale unseen since the upheavals of the 1930s. Recognizing this trap is crucial, not to alter the inevitable outcome, which is impossible, but to position oneself beyond its reach. Assets such as gold, Bitcoin, tangible resources, and productive enterprises exist outside the confines of this financial hostage situation. Both nations, caught in this precarious trap, remain silent. China avoids revealing its awareness to conceal weakness, while the United States refrains to prevent causing panic over China's leverage. Consequently, each side proceeds with gradual, calculated strategies, hoping to escape before the proverbial cliff gives way. Yet, that cliff is disintegrating, and time is running out. Grasping this reality reshapes your understanding of the U.S.-China relationship, revealing why neither can triumph in this standoff. It exposes the true mechanics behind global finance, not the political narratives or media fears, but the underlying structure of the trap itself. By tracking these developments, you can position yourself outside the system, investing in assets unbound by the dollar's captivity. The $3.2 trillion trap is the most significant financial dynamic today, yet it goes largely unnoticed. Both governments conceal it. China fears revealing weakness, and the U.S. avoids acknowledging China's leverage. Thus, both continue their slow, quiet strategies. The crumbling cliff signals that time is running out. Understanding this shifts your perspective on the global economic chessboard, revealing that, over the next 5 years, this trap will either loosen gradually or collapse suddenly. Either outcome will mark the most consequential financial story of this decade. In the upcoming discussion, I will reveal what China is secretly purchasing with the dollars migrating out of treasuries, assets beyond gold, including 3 other investments that few are tracking. Knowing what these assets are will tell you where intelligent investors see value once the dollar trap finally bursts.